Feet on fire. God, I feel like Yao Ming. Get a picture, would you?
David just took one.
There you go.
Good afternoon.
Just make sure we're projecting. Yeah. Okay. Can you do a sound check for everybody on the internet as well?
Hello, hello, hello. Can you all hear me? Hello? Can you hear me?
Yeah, just do it.
Yes.
Okay. Good afternoon for Sunday. A couple of things before I start with it. This weekend here, listening to Tom Williams, which is the first time I've heard of him, meeting Gavin for the first time, David Weiss I've known for a little while, Dr. Gary Dayton I've known for a little while as well. It was one of the most enlightening weekends I've had in my life, and I've been in business since 1981. And the reason why I said that is that we took 4 to 5 different people, and Gavin, 4 to 5 different people that they didn't know what I was going to produce, or David. We all came from separate angles, not knowing what each one was going to have. And and it worked out the fact that we all took something of Wyckoff, and it reinforced everything that I knew for 28 years. But every time I do it, it's just that much greater because it enhances knowledge. And to me, for a lot of people that are new, it's probably very overwhelming. And thank goodness you have a video. But it's overwhelming when you hear the same thing over and over again. It's like your mother tells you not to cross the street, watch for cars. You don't believe it. You keep doing it, and eventually it happens. A couple of things I want to mention before I start again. Number one, why do springs, you heard a lot about springs and upthrusts. Why do they work? Anybody? Right, that's part of it. Remember yesterday I mentioned to you that markets maybe 70, 80% of the time are in trading ranges? You don't see markets just mark up and mark down. I'm going to prove that today to you. And there's a little thing about the S&P, about news today, which manipulation-wise, which I'll kind of share with you that Gavin wanted to know from Friday. But we didn't get to discuss it. But springs and upthrusts work simply because most times we're in trading ranges. And the markets don't leave those trading ranges. They eventually do, and I'm going to identify you. David Weiss gave you opportunities of where you break out, where to look for trades. Dr. Gary gave you where to look out for trades. Okay. David said to fish at edges, ice, and creek. So if you just are in a position where you're patient and you wait, I'm sure VSA has signals as well. If you're patient and wait, those opportunities come all the time. And you cannot not be able to not take a proper trade when it happens. Okay, so that's why springs and upthrusts work. Because markets mostly are in trading ranges. Yes, they talk about the trend. If you buy every support of an uptrend, sloping line, a channel we drew, if you buy higher lows every time, eventually that support's going to break, but you know what? You're going to be making 10, 12, 15 trades in a row. You don't know that a market's going to retest all the way. You don't know when a market gets a sign of supply, a sign of strength. You don't know that's going to happen. Follow your trend. With that, I'm not going to do bar charting. I'm going to put it all together to you. I'm giving you the meat of Wyckoff. I'm taking all these bars that Gavin told you, that Dr. Gary told you, that David told you, and Mr. Williams told you, and putting it all together. And I'm going to show you what David and I call what the story is. And the story is the schematics that I showed you. And I'm going to tie it into news because we're talking about the website market manipulations that Gavin has now, that I've seen. It all ties into it, and I'm going to explain to you how 9/11 wasn't an accident and how these things happen. We're going to go through this. We're talking about strength. Everything I talked about yesterday, we're going to tie in today. If you go to the schematics on accumulation, the first chart. Okay?
Gary?
Yes.
Can I just clarify something?
Please.
9/11 being not an accident, you mean the movement in the market?
Correct.
Okay. Just clarify that.
Yeah.
It's not a conspiracy theory.
Right. No. I'm not Oliver Stone.
I was thinking about that. I was like, just to clarify, it was the market reaction to that. Yeah.
That day, the market told other CMs through price and volume that the market was going to bottom. Thank you. I get the Homeland Security, but you're
Don't get me in trouble. I'll be telling my friend Paul at the back there and Andrew McGuire, I'm not a conspiracy theorist. And here's one of our keynote speakers, Paul. Get on the phone to Andy.
It was an inside job. No. This doesn't. Okay. Okay. So anyway, it's not. It's okay. Let's go back to schematic. This is the heart of Wyckoff, which is what I'm going to go over with you. Let's go to the left side of the range. It's accumulation. You see, and this ties in with Dr. Gary. Okay. You see the market breaking here on the left side. It's just your downtrend. It's your selling, overcoming, buying. This will continue until you get ending action. And I talked to him yesterday, how do you get ending action in a downtrend? You either get a lack of supply, but ultimately, you need demand in a downtrend market to turn up. So, the news is bad. The composite man is short. News is worse. The market continues down. You hear it CNBC, all new stuff. Bad. Funds are selling this stuff. Okay? The CM does not, composite operator does not sell breaks. He has a position. And we'll explain to you this. The first reaction on good volume and good price action is what's labeled at number one. It's called a PS. That's called preliminary support. It is the composite man saying to a composite man, saying, hey, folks, we're about to end this downtrend. The news is getting bad. We're still short, but we know that there's going to be some ending action soon. And what we're going to try to do is we have to cover our shorts because if they're short 30, 40, 50,000 contracts, they don't do it at one price. They accumulate over an area, and I will explain this to you. So the first reaction up, who causes that? The market's in a downtrend. Who causes number one, the PS? Who are the short sellers covering? Who are the short sellers covering? Is it the funds and the specs who are enjoying the downtrend? Who's covering that? It's your smart money. It's your composite operator. I feel like Dumbo. It's saying, hey, this is my signal, folks. This is my signal. We have to cover some because we can't cover it all the way down. They buy, they cause a massive rally. Not a massive rally, but a rally. I'll show you. Some of the weak shorts cover because the market bounced up. And the smart guy who watches CNBC says, you know what, folks? I'm going to buy this low. This is a bottom. News is bad. I'm going to buy it. He buys it. The composite man, smart money, is still short. The market breaks down. Okay? But that could rally, the market breaks down. The sharp rally afterwards, the high volume rally, leads to the final climactic low called a selling climax. That is when the news is horrible. Those people that bought that little rally and got stopped out, they get out. They puke. Your margin calls. Crude oil is in the agency, whatever it is. All those stories, the things are the worst. Something you haven't heard here, there's a transference of risk. That's what markets are all about. It's a transference of risk. You're getting the big, large interest knowing that it's getting to a point where they want to own the product. The news is horrible. They know the feeling of it. And they say, hey, get me out. And the CM says, buy it. What price do you think smart money gets on a selling climax? The best. Because everybody is selling it. He's saying, he doesn't have to bid the price up, does he? He buys a falling market. So he covers some of his position on preliminary support. He covers the rest on the selling climax. The news is the worst. High volume, large price action. Classically, that's how it is. I will tell you that most markets are not classical. You have to read through the lines. You have to read through the lines, okay? After the selling climax, you get something called the automatic rally. They conduct the rally. Why? Because this is where everybody puked out. Anything they bought, they have an automatic rally to sell the rest of the contracts out. There's a big fight there. The news is the worst. People are margin call, and that's it. Then we go something called a secondary test, okay? The market will form a trading range. This trading range should last anywhere from an hour, if you're an intraday trader. It will trade for months, for years. Remember what Dr. Gary was talking about, that final vertical down? That's what you see on the preliminary support and the selling climax. That get me out at any cost. I will tell you a story. When I was in the pit, I was in '87, and I was short these put options and calls, and I was getting hammered on these calls. I mean on the short puts when the market was going down, and they were like 2,000 bid at 3,000, very wide spread. And the guy goes, "Gary, you got to blow out. You're wrong." I said, "Can you put a bid in at 210?" He says, "Gary, the market's at 2,000 to 3,000. You want to put a bid at one tick off the support." When they want to get out, the point is they get out. They puke. They don't care about price. Last Thursday, you saw that. When they went out, they're gone. The one thing you have to understand about vertical down moves at the end is that they always will form a trading range afterwards. It is this trading range that most people lose their money. Because everybody at support sells because they think it's a downtrend. And at resistance, they buy thinking a breakout. This is why springs and upthrusts work. The news is terrible. The news in the trading range remains terrible. And people say, we're going to make new lows. The composite man talks to other composite man and to you, because we're learning Wyckoff, by price and volume. Preliminary support, selling climax. Classically, that's how it works. What you will see in the trading range is on the left side of this particular range, the market will be a little more volatile. As you get to the right side of this trading range is where you begin to see the beginnings of a market that will begin to mark up. And this is where David showed you the examples, and Dr. Gary showed you examples, and I'm going to show you examples. On the right side of the trading range is where you find your money. You've got to be in harmony with the market. And from yesterday, I told you, do not let money be tied up. When you're in the trading range, unless you want to scalp it, which is very difficult, wait for the market to do something on the right side of the range. It gives you a better, clearer picture of the market. How many times does a market test support in a trading range? A million. It doesn't matter. It could be 10, 20, 30 times. Okay? The last spring of a trading range is called a terminal spring. It's the last spring you'll see in a trading range. Sometimes you get that final jab, the testing of the supply to the downside. Yes?
So you're saying that every trading range has a terminal spring?
No. It can't end. Yes, it can't end with a terminal spring. The final spring of a trading range is a lot of times the terminal being last. So it's the last spring of a trading range. The quick little dip is just generally the end of the trading range before it has markup.
Yeah, I thought the terminal spring was something like a little more severe penetration of the support and then bounce up.
There's three types of springs. There's number one, Wyckoff describes a 1, 2, and 3 spring. So it could be a light volume spring, it could be a heavy volume spring, it could be a lot of different springs. But I mean, terminal springs you don't see often. I'm just saying, but they have one here, and they have the final spring before markup, which is why I mentioned it to you. On the right side of this trade, now you understand what the right side of the trade range is? On the right side of the trading range, when you talk about buying and selling, when buying overcomes selling, you know what those bars are like. We discussed those. When you get a sign of strength, it's a specialized buying bar. It's a bar that has increased volume and increased range on the right side of a trading range. It's very, very important. Why? Because once you identify that, you're very close to marking up, and you want to be very, very careful. And I'll show you this in the charts. When you get over this little creek, which is resistance in Wyckoff terms, many times the market will continue to go higher. Sometimes we'll test back under it. It'll be like an upthrust. And the last point of that part is called something called LPS, the last point of support. Okay, and you see this chart-wise, and I gave you the glossary behind it. But once you get the sign of strength, that special demand bar of increased volume and increased bar, the market is about to make a move. Do you want to sell an upthrust? No. No. Because, you know why? Because that sign of strength is telling you demand is overtaking supply for the first time. Remember I told you you want to see demand come into the market? That demand saying, we have accumulated, and sir, we're about to go up. It's a sign to the other smart money that's going to happen. That upthrust, you may or may not get it. You may jump over the creek and continue higher and never retest. Very dangerous to sell that upthrust. Any questions? Okay. Next chart. Same thing downside. Gary, I think, went over it. Distribution, the same exact. What's true on the up is true on the down. Okay? Selling climax. If you look at this chart closely, what chart does it remind you of? The S&P. This LPSY is the last point of supply. If you look at your S&P chart, I didn't put the daily in. If you put your daily chart, and I'll show you LPSY, it is the 1207 area in the S&Ps. It's a rally that went above some support and went back through it. The breaking of the ice in the S&P was 1080, and you get down to, 1180. You went down to 1060. The ice was 1075, 1080. You went to 1073.50 the other day, and you broke back down. Let me explain that to you, okay? Remember the question earlier today, by the way, that Gavin, somebody asked, and Gavin asked David about why a market in the daily S&P didn't retest in 2003? I'm going to show you that it did. Okay? So I'm not going to go over this one for time purposes, but it's the same thing. If you reverse this back, it's the same chart. Unless anybody wants me to go over this chart. Okay. Let's go. This chart. What stands out to you in this chart? This is the NASDAQ. What stands out to you in this chart? I didn't hear that. Thank you. That I heard. This is the most obvious buying climax that you'll see in your entire life. Frame it whatever you want to do. If you remember the dot-com craze, everybody was day trading. Everybody, the little monkey doing the thing, all the commercials with the helicopter. You talk about news at the top, everybody was doing it. Any stock you pick, you made money on. We broke. You see the hard break? Why I wrote reaction low on support? Okay? The first reaction low is where we draw our horizontal line. Did we hear that today? I think David Weiss told you that, right? The first reaction low from a high, you immediately draw that line. Immediately. What do you get after that? You get a secondary test. This is classic, folks. This is classic. Okay? And you see the results. Do you see how severe on the vertical? This is the dot-com. This is the news that it gave. This is the most manipulated top I've ever seen in my life. Why didn't this market form a trading range? I just told you after buying climax, we form a trading range. Why didn't it do it? Because they had the longs by the you-know-what. This was such a major buying climax, they did not allow those longs to get out of the market. It never retested too much. It never did anything bad. But I will tell you this. Most times, you'll get some type of full retest, or, in worst case, you'll get a halfway back retest. And Wyckoff used that as a guide. So from the low at 3,000, you went to 4,100, and the high was about 5,000.
You need to use the mouse.
Okay, I'm sorry. So when you got this high here, so from this high here, wrong, okay, from this high here, from this low here, how do you know how it's going to retest? You don't. At a minimum, you take halfway back. At a maximum, you have an upthrust of the buying climax. And I'm sure it's programmed in VSA that would turn. I saw the program a little bit, but not real familiar with it, but I'm sure that was the case. This is a monthly chart. This could be a bar chart or 5 minutes. I'm showing you how the bar charts are working together as a story. Okay? Any question about this buying climax? Anybody not see this? So I can't go on unless you see this.
Your most important point is that there's no range developed afterwards.
Because it was such a F job of the people that were long that they were all long. You could see the buying climax. They had them trapped so badly, and you know the news, the monkey and everything else. They did not let the longs out. The helicopter Scotch trade, it was the most obvious piece. If you want manipulation of a market, this was the most obvious. And I'm going to show you how this all ties in. Next chart.
Does everybody remember the new economy?
I'm all fired up. I'm telling you, this is good stuff.
There's no profit. It doesn't matter this time around. This is the new economy, right? That kind of stuff was classic bubble, classic buying climactic kind of environment. I remember I was working in a hospital as a
Gary?
psychologist, and
You need to come and because
sorry.
we've got people here saying if you're talking, you need to talk
yeah,
into the mic.
okay, I'm sorry.
Tell them next time they come in at 10 live and you want to.
Yeah, come live next time and you'll help you. Sorry.
The fun that we're all having.
If y'all remember back in 2000, it was the new economy. All of these internet stocks were not producing any profit. There were no earnings, right? It was all cost, and yet people were saying it doesn't matter. This is the new economy. And no more bricks and mortar. We're going to do it without any costs and so on and so forth. Whatever the rationales were, it didn't make any sense if you step back and looked at it. Every night, even on PBS, the McNeil-Lehrer News Hour, I was amazed. I watched, and the NASDAQ is making a new high again tonight. And the NASDAQ is making a new high again tonight. You know, they hardly ever report that, and yet there they are on the most staid and conservative kind of news program. They're out there beating the band as well. I was working in a hospital, in a medical center as a psychologist, and I remember I heard one of the male nurses say, Microsoft is going to put my son and my daughter, not just my son, but my son and my daughter, both, through college. Thank you very much. Everybody was buying. It was just an incredible time. And that's what you see here.
Thank you. If you lost money from 1990 to 2000, yeah, I think you'll never make money in markets. I mean, I'm serious. I'm talking about a standpoint of if you own the stock and you pick the stock that didn't make money, you're not supposed to be here. Honest to God. Okay, I lost money. No. This is the S&P 500. The S&P 500 is the institutional index that they all use. It's the most important one. They got the Russell and everything else. This is the one, okay? Before I forget, Gavin kind of stole my thunder a little bit when he mentioned about the 240-minute Forex chart, which is absolutely 1,000% correct that is the best chart to use. The best chart to use when you trade the S&P, what do you think it is? Not you. I told you. Hourly chart. is what the institutions use. It's the number one time frame they use. They use the daily, weekly, monthly, yes. The hourly chart takes out the noise intraday. What you do is, and what I recommend doing, and I've seen it done, is you take the hourly chart, you get the VSA program, you take a 5-minute type of move up, and you follow through. But let me warn you, something very important. If you trade a 5-minute chart, I said yesterday, you must get out on a 5-minute chart. And I'll tell you why. The cause is built for a 5-minute chart. If it goes a little bit higher on a 5-minute chart, and now, oh wow, the 15-minute chart looks good. Your cause used up, people say, oh my hour looks good. They take it home, and guess what happens the next day? They get a gap. If you trade a 5-minute time, do not mix time frames. I know if a 5-minute chart works, and I was in his chair room last week, perfectly. At 5 minutes, 10, 15, it doesn't matter. Be true to your time frame you're trading. Most people turn time frames into something longer. Back to the S&Ps. Where's the buying climax here? Is it like the NASDAQ? Not even close. It's a gradual uptrend. Okay? This is from 1982 going up. It's a monthly. In this particular chart, you get a little better retest than you did in the NASDAQ. But you see what happens. Look at the decline in the NASDAQ, how quickly that was, and look at the S&P. We talked about comparative strength and weaknesses, and Mr. Williams talked about that today, about the stock. Well, I'm showing you comparable weakness on indexes. Okay? It's fine. I'm going back to these charts, so we're going back. This is the Dow. You'll see on the left side of the Dow, 2000. Same thing as the S&P, correct? Look where the retest stopped in the Dow in 2002. It stopped at a spring area. You can see right here? There's a perfect test. You didn't know at the time. Perfect test. Something very important. You know in 2007 everything collapsed. Look at 2007 on this chart. You had to jump over the creek. We'll go over this. But look what it did. The Dow went up 2,500 points above the 2007, above the 2000 highs. Do you see that? The new highs in the market here. Let's go back to the S&Ps, for example. Let's go back to the NASDAQ. Look at 2007. Where's the market? Not even a third of the way back. Which is stronger, the Dow or the NASDAQ? NASDAQ was horrible. Horrible. It never recovered. Look where it is today. Not even close. Comparative strength and weakness. Again, Mr. Williams talked about that with stocks. You always want to buy strength. You always want to sell weakness. Do not buy weakness and think that it's going to catch up. I think Mr. Williams said that today.
You call him Tom.
Okay, Tom, okay. Tom, okay. It's not, thank you. He said the same thing today to you. Remember, all that stock doesn't look good. Trade, you buy strength and stuff. Most people say, oh, I'm going to buy the weakness, it'll catch up. Wyckoff, no. You want to do it your own? You create your own system. It's your NASDAQ, okay? I'm going to say something to you. Look at what happened in 2007. We talk about upthrust being very important. Look at this chart. Do you see an upthrust? It was a perfect retest of the 2000 highs. This was an institutional market. If you traded this market and you traded the first retest, you got out on the highs. This is not hindsight. This is what happened. If you remember today we talked about springs and upthrust? If you sell an upthrust, you sold the high of the market. If you remember 2007, everything was good again. If you remember the news, go back to it, article-wise. It was news, okay? Look what happened in 2007, this chart. Remember we talked about this? Way higher. And the NASDAQ, way lower. Okay? So you compare your strengths and weaknesses, okay? And look what the Dow did. Let's go back to the Dow chart. You draw, anytime you draw, when you have a high or a low, like today with horizontal lines, you draw a line across, this line here. This is a creek, first high, which forms an ice support. This is, so we talked about, this is the low here. Now you already have a sign of weakness, correct? You already have a sign of weakness, pardon me, here. It's your sign of weakness, right? Wide bar here. The rally after the sign of weakness, the weak rally, which was the S&P did at 1207 on the daily chart, is what we call last point of supply. It's on your sheet. It's the last rally that says to the longs, oh, we're going up to the highs again. And the smart money who's already sold it says, here, baby, I'll give you whatever you want. After that happens, we have a breaking of the ice. I'm comparing it to the daily S&P. We had it from 1207 on the daily chart. We broke the ice at 1085 to 1082. It's happening in front of your eyes today. Okay? This is, it's not high. I like to give live charts to my clients and to people that go to my chat room because what happened in 1920 doesn't mean nothing. We got to talk live markets because we're here to try to make money. Any question on the difference of the Dow? The NASDAQ is horrible compared to the other indexes. And you see, where did the market bottom in 2009? Remember we talked about earlier about a market, you say, where's the secondary test of the daily? You don't see it on the daily chart, do you? You made a low of March, and you went straight up, right? We went over the chart. What do you see here? You saw probably the most perfect spring I've seen in a long time. It's a monthly spring, folks. This is not a 5-minute spring. Look at the range here. Don't look at that range. Look at the range here. If you were long, you probably got wiped out because you thought it was going lower. Look where the close was. This was 2009 with the Bear Stearns and all the bank stuff. I mean, and you obviously know how bad that was. Okay? This rally should have rallied back, up a little bit to retest that little ice area. Would be ideal. This chart this chart is current. It's a monthly chart. It's for May. So we almost went perfectly to retest. But you see how springs and uplifts work on a long-term chart? This is classical, folks. Classical. Look what happened here. Just the up thrust. Dow made new highs. NASDAQ didn't, and boom. Yes?
When you see an up thrust like this,
Which chart? Yes, sir.
Yes, the last bar, when you see an up thrust like that,
Yes, sir.
couldn't the stock just have gone sideways, for instance? Couldn't you see more than one up thrust?
The question was, at the last bar, could you see more sideways before anything happens? The answer is, yeah, possibly. Anything's possible. I will tell you this. The first retest of a low or a high will generally fail. The more times you retest it, the more times you're going to go through it. The least times you retest it, the least time you go through it. Right? So the first retest almost invariably almost always fails. Had this market gone sideways and had the closes been high-end range, this is something I don't think Dr. Gary and David told you. Not they're hiding anything, I don't think they told you. How do you tell the difference between absorption to go higher and distribution to go lower? Anybody know? We don't. But we get a good clue by the closes. If the closes are high-end, we know that demand is overcoming supply. Buyers are overcoming sellers. If the close are low end, the mid-low range, who's winning the battle? The sellers. That's how you could tell a shorting of the thrust and absorption in the market, by the closes. They're very difficult to find, but that gives you the advantage, a little edge. So if you go sideways, at resistance, what do you expect? You expect selling. If the market does not come off a selling area, like the dollar index yesterday, the market's going higher. It's absorbing the sellers. If those closes are high end, we're going to go up and jump over the creek. This is that same chart that I labeled for you. It's labeled nicely for you. Remember, David, with the horizontal lines? Pardon me. The first reaction low is your horizontal line across right here. Okay? I don't care how you get there, whether it's Wyckoff, VSA, I don't care how you get there. Get there. Get to understand what it's telling you. Get to show you the power of the bar chart. I'm not doing bar charts now. I'm doing areas. This market had a retest and a sign of weakness. Okay? You see the can anybody identify the last point of support? I mean, the last point of supply in this chart? It's right here. The little rally. This rally was weak, wasn't it? The bars were weak. It did not run away from support. Breaking of the ice. The best Wyckoff trade that you can have on the short side is a retest of broken ice, because supply has proven itself, and the market is in a change of behavior, and will go down. I'll repeat that. The number one short opportunity in a market is when a market has had supply, a buying climax, and has had a sign of weakness, followed by a breaking of the ice, breaking of this area, and a retest of this area right here. This is your sell right here. This is your sell right here. How much risk did you take? I didn't make this up. This is I didn't make it up. This is what the S&P did at 1075 just recently. So I'm trying to equate it so you understand. It's not theory.
Yeah, we've got quite a question from the audience on the internet. It says, while it is true that the Dow went much higher up than the NASDAQ, the relative magnitude of its drop in 2007 was greater than one of the NASDAQ. How does this relate to the relative strength of the Dow versus the NASDAQ? In fact, you better repeat that back here. That's the question.
Yeah. Let me explain the question.
Yeah, read it to the audience. Yeah, it's from Matt B. So hello, Matt.
While it's true that the Dow went much higher than the NASDAQ, the relative magnitude of its drop in 2007 was greater than that of the NASDAQ. So how does this relate to the relative strength of the Dow versus the NASDAQ?
Yeah.
We talk about manipulation. The Dow Jones is the most manipulated market out there, and I'll tell you why. It's based on how many stocks? 30, right? If a stock does badly in the Dow, what do? They kick it. When a stock goes into the S&P 500, they're forced to buy it. Institutions buy it to do the Dow. You can have a stock like a GM in the market, which is 0, which was in the Dow, and these stocks. You could have 2 or 3 stocks index do very, very poorly, and the index gets all screwed up. For public consumption, manipulation, when people see the Dow, what happens? Euphoria. The Dow's new highs. The Dow's new highs. In reality, the market itself, the NASDAQ and the S&P, do terrible. So the answer to the question about the Dow being relatively down lower than the NASDAQ did is because the Dow was manipulated by the 30 stocks that are there. How many stocks in the NASDAQ? 3 or 5,000? So it's easy to move the Dow back up and down. And since the public likes to look at the Dow, that's how they can sneak down prices in the NASDAQ and the S&P and keep the Dow up there. So it's all done by manipulation what they do with the Dow. 5 stocks in the Dow that are weighted could make the Dow be anything they want to make it. But what does the public look at when you see them? They look at the Dow. If you say to them, what the S&P's closed at today? Not a person in the world knows unless they're trading. Yes?
I understand on the chart 5, I understand where you get short on the retest.
Please, okay.
But if you're long, let's say into January 99 and into January 2000, right in there,
Mhm.
where would you exit that?
Good question.
Can you repeat the question, please?
Good question.
To that, please?
Yeah. The question is, in this particular trading range from 1999 to 2000, if you were long, which you should have been, where should you have gotten out? I one day want to work with Gavin and stuff because I like to run past data and see if when VSA turn, but down the road. But I will tell you, when you get wide bars on the top, it's telling you there's a battle going on. Do you see the wide bars on the top of this chart? Percentage-wise, as the market goes higher, you will get more volatility. That's why that's why the S&P crash in '87 was so gigantic, because the Dow was the S&Ps were a much lower level. It was only 500 points. We had breaks bigger than that, but percentage-wise, it was huge. Absolutely huge. At the lows, you will see ranges. You'll see ranges that are smaller. When you get $20 crude oil, you're not going to get $10 ranges in crude oil. Today, you get $10 ranges on an opening. Okay, so it's all relative to a percentage-wise. The answer to your question is, once you see stopping action, I call it a change of behavior action, supply, you want to get out. Okay. In this particular chart, you don't see that until this bar here. Why? This was a secondary test. It's some type of retest, correct? It didn't make new highs, but a secondary retest. What was the close? What did that tell you? It's, as the market went higher, and we always told you, I didn't tell you, but Gavin always tells you, and it's absolutely 100% true, selling comes up on strength. Selling comes on rallies. The market was going up. Look at the bar beforehand. Look at this bar. It's an up bar, correct? Everyone says, oh, that's bullish. The next bar is we made a slightly higher high. Shortening of the thrust, I call it. I think Gavin may call that a lack of demand, but it was a lack of upside progress. It just barely made a little bit higher high, didn't it?
Yeah, Gary, can I just clarify?
Please.
It's not no demand. It's called a hidden upthrust.
Okay, a hidden upthrust. Okay.
Yeah.
One day I want to go through the hidden upthrust. But whether it's a hidden upthrust, whether it's a hangman, whether it's a double top, whatever you want to call it right. What was the close of that bar? That was the bar that you should be out on. It was a secondary test that failed. The next bar, let's do a little bar by bar. Next bar, what do you get? A break to support. Should you get a reaction? Absolutely, you should. Did you get one? High range close. One question. You got a high range close, correct? One of the most important things about Wyckoff, besides if they told you, is called follow through. I think David Weiss told you that today. What was the next bar after that bar? What was this bar? What was this bar? This bar here. The market did not have follow through. Not only did it not have follow through, it made a lower low and it closed lower. Game's over. Game's all over. Supply was tested and sellers came in. You had a question.
Yeah, what about the bar? It's,
I didn't want to do bar by bar, but okay.
for the retest.
This bar?
The previous one.
This one? A market in a trading range will churn up, down, up, down, up, down. You see that one bar higher, one bar lower, and that, you know what that is? Bulls and bears fighting it. The bears are saying, I'm making a stand. The bears are saying, I'm making a stand. When you see action, high close, low close, high close, low close, buyers one day win, sellers win. Buyers win, sellers win. When you see cluster closes, you're about to break out, correct? You're about to make a move. When you see a high range, low range, in a trading range, it's telling you there's a battle going on. Because if it's a high-end bar, you're going to say it's a demand. If it's a low-end bar, you're going to say supply. In trading ranges, you will see this type of action at the end of a move. So up bar, down bar is what you expect in the market. That's why that you get that up and down action. Yes?
Gary, I want to make sure I get the support and resistance lines correct. I see you have drawn a support line on February, and I thought you drew a support line after that high, the March high, which means you would have drawn a support line at the April low.
Yes. You talk about, let me ask you a question. This low here, you mean?
No, I'm talking about January 2000.
9? This low?
Oh, I guess I'm reading the chart wrong.
This low?
I'm talking about 2000, yes.
Why did it?
That low and not 3 or 4 bars later. Because that would be following the high.
So you're trying to say, why did I draw my horizontal line starting here? I don't know. No. I do know. Great question, though. Do you ever watch, the question is, why did I start my horizontal line here versus here? Correct?
Or by
After the high, far after the high.
This bar here?
Right there.
that one.
That low.
It looks more prettier, doesn't it, when I do it? I'll tell you why. It's a good question. I don't know. You know, you ever play football or ever seen football on TV? And the goal line is all around the world, so they only need the ball to cross the plane of the goal line. I extend my horizontal lines all the way through. It tells me a story. Okay? The reason why I drew it there, okay, is because that low was not many people do this, but that was the last low before the high. Thinking, once they take out that low, once the buyers get taken out right here, those people are losers. So I take the last reaction low before the high, and I try to play with it. One thing that David didn't tell you, and one thing that Dr. Gary probably didn't tell you, is that in theory, these ice and creek lines, ice being support and creek being resistance, are not straight lines. They're wavy lines. It's a creek and it's an ice. It's a wavy line. How Wyckoff would draw this chart properly, you can hear it back at the yep, I got a big ball. How Wyckoff would draw this chart, I'm sorry. How Wyckoff would draw this chart, he would draw this low, back to that high, back to that low that you're speaking of, this one right here, and he'd make a wave. Oops, sorry. He would make a wave. He would do this. Take this low, and he'd make like this. Be a wave. That's how Wyckoff in theory works. In practicality, we do not draw those lines that way. We draw them as straight lines. But in theory, okay, a creek that's why it's called a creek. It's a wavy line, okay? So that's why. But I always draw my line, and I draw a story. I could have drawn the line you did too and made it like a little, like, sliver. Because I don't care about one price. I care about an area. Just like when the CM covers at preliminary support, he only cares about the area of accumulation or distribution. He does not care about one price. So you could draw two lines that way. If you look back at the chart on the schematics in Wyckoff, do you see two lines? Let me go back. I'm glad you got me fired up. That's good. And don't get me fired up. I'm fired up. Oh yeah, I was up at 3:30 in the morning doing charts.
I know.
Nuts, and we were out to like midnight, so it was not good. Yeah, I love it. Anyway, you see the trading range D and the resistance line C? It's not one line. You see the creek, how the creek is drawn here? How's it drawn? Okay? Your trading area is not trading points. So great point, but I take it because I take the last reaction low before a high. Because I know that once that low is taken out, that's when all those buyers become losers. And what are markets are about? It's about making money, transfer risk. So once those people are forced out of those markets, the game is over. When you look at your statement when you go home at night, it only matters on closing price. If you're in a position trader, it doesn't matter what happens at 9 o'clock, 10 o'clock. Only matters closing. That's when the brokerage firm puts in money, takes money out of your account. It's the closing price. So it is an area. It's a great question.
Yeah, good question.
Switch seats. Great question. Did that help? Do you chart? All right. So we had marked down and everything else, okay? This is Gavin just broke his ears up here. 2001. What's the trend in the market between 1999 and between 2000 and 2001? I'm sorry? Between 2000 and 2001, what's the trend? Well, we made lower lows, right? We're making lower. Whoa. Let's back up. Once we get a sign of weakness in a market, we have a change of trend here. This bar here is if you compare, look at the NASDAQ too, this bar here says sign of weakness. What do you need to turn this market back up? Demand. Up until 2001, you don't see demand, do you? If you do, then you got the chart upside down. Okay? By the way, think about upside down. Let me tell you a little trick. I got a ton of it. If you don't know what's going on in the market, put a chart up on your wall, turn it upside down, and if you would buy that chart, if you don't want to sell it, don't take the trade. I do it all the time. Flip the chart upside down. It should give you the opposite result. If it doesn't, something's wrong, right? And in doubt, stay out. In 2000, here comes a conspiracy. 2000, it was a dot-com that ended, right? The market needed some type of demand rally or some type of stopping action, correct? To stop the downtrend. What was the most bearish news of our lifetime? I don't think anything more bearish than 2011 because we didn't know what the economy was going to be like. We didn't know if there was, you go back there, everything was probably the worst I've ever seen in my entire life. I'm sorry? 2001. September 11, 2001. I think it's probably the most scariest time I'm 50 years old in my lifetime. I don't think of that. Maybe different. I don't think there was one worse. The market on that negative news should have done what? Gone down and closed on its lows, right? It should have been like, get me out. Don't forget, this happened in the middle of the month. It didn't happen the first where they had the whole thing to recuperate. It only had 2 weeks to chart. What was the closing that day? On that month? In the middle. Who bought that? I guarantee it wasn't Joe who was shining shoes saying, Oh, 9/11, I think we're going to go higher. It was the most obvious, most bearish. We talk about, manipulation. I just showed you an example of the Dow and this. The most obvious thing that I could think of was the most scariest month in the history of our lifetime. I can't think of anything more scary than that. And the market closed in the middle. Who bought that? As Tom says, it has to be professional money. That month, the CM said to other CMs, you know what? We're going to go into a bull market run. But because everybody sees that type of action, we need to see a retest. I think you've heard that 1,000 times today. Okay? If it is a strong rally from 2001, maybe we don't retest. Maybe we just go up. It's a shakeout. Okay? What is the next 7, 8 bars after 2011? Is it a good quality rally or a bad quality rally? The ranges are small. The volume is nondescript. It's not good. Okay? The rally is here. These are not strong rallies, are they? No. What does that tell you? Secondary test. We made a new low. Right here. This is obvious as day can be. You have to identify this. What is this? What is this bar here? What is the volume and what's the price action telling you? This is even a high range close. It's above mid range. The volume increases. It's the highest volume you've seen. And look at the close. That's your selling climax. Any question? I mean, I'm all tied up in today's market. What do you get after a selling climax? We talked about it. An automatic rally, which you did. You get some type of secondary test, correct? Did you get that? What does the secondary test tell you? See this bar here? One of the most important bars of your chart. Market tried to go down, retest, made a perfect retest. What was the close? Well, who's winning the battle? That's what I think about all day long. Who's winning the battle? Who's making money? Who's losing money? That's all I think about. Buyers. Okay? We go up and make a high. And resistance the first time up, we're going to fail. Most likely, correct? This is, again, refer back to Tom Wise. Look at the upthrust there. And all you people that trade upthrust, there it is right there. This is more of a dangerous upthrust because you already had, once to Wyckoff, you've had a selling climax. Your trend becomes up, not down. You don't trade necessarily upside until you get to the right side of the trading range, and we'll get there. So we get a retest. Look at this bar here, the most significant bar, and I don't know what VSA calls it, but I'm going to find out in a minute. The market attempted to go down. What was the volume? The second highest volume since the selling climax. You all see this line here? Close in the middle. What happened? We tried to go down. Professional money bought the market. Why? Because if you had a selling climax, a good close, and here, I don't know, what does VSA call that?
I'll show you exactly.
Please.
This is a market bottom, as Tom would show you. That's fine. Just quickly here with Gary. This is exactly how you'd read this in VSA. These are actually the indicators, but I'll just show you them. Climactic action. Sign of strength 1, massive volume. Yao Ming, the basketball player, has jumped out at you and said, hello. Suddenly professional money are very active, but what makes that bar fascinating for all of us is it closes up higher than the middle. So we immediately know professionals are actively doing something. However, it's not going to, very rarely does it take off. It usually goes into what we call a stage of accumulation, which accumulates at the base. So I always mark the bottom of a climactic bar with a line. And my stop, if I see it, goes, if it's a stock, to maybe a small percentage below that. But that, if I see that, it's highly unlikely to penetrate that unless there's some sort of down thrust, which can happen, but it's rare after that volume's taken place. Can anybody tell me,
John Amin at the back here. This is one for your daughter. What would that be called in Trade Guider? Those two bars. Well done. Bottom reversal. Exactly that. Sign of strength. Another green indicator right at the base. So you've got sign of strength there, okay? And then we've got this bar here, John. What would that be there on that volume? It's this bar here. It's narrow range, low. Oh, hold on a second. I don't know what happened there. Yeah, it's. Sorry, there it is. It's this bar here. It's a narrow spread bar. The volume's lower than the previous bar. Okay, it's the narrow spread. The volume's still quite high, and it closes in the middle. And the next bar gives you a bit of a clue to what the signal would be. No, I'll tell you. If that bar there that I'm pointing at was on very low volume, lower than the previous two bars, the software would see that as no supply, and the market would probably highly likely take off. But what we've got on two bars, we've got high volume on down bars. This is actually almost a level bar, but it would count, and it's classed. In fact, I would have said that the stopping volume's on two bars over two periods. That can happen. You can get two signs of strength after that. It could even be shown as a shakeout on where you've shown stopping volume there. That could be shown as a shakeout in Trade Guider after you've seen this, because they're shaking the market out one more time to get rid of it. So you've actually got climactic action, a two-bar reversal, followed by stopping volume. Now, the best place to trade that, if you want to be very conservative, Tom would buy that. What I would do is mark the top of where we're at, where we go through the rally. If we move through that and retest it on low volume, narrow range bar, no supply, or what we call a tested a rising market, which I'll show you later, that is a very high probability entry to the long side. And Gail's nodding there, because you saw me trade that, I think, in the New York Traders Expo. I took a live trade on that exact principle.
And notice that the closes are the same on those two bars.
And the closes are the same on those two bars. Yeah, the close is relevant.
On monthly bars.
Yeah.
Gavin, thank you so much. I mean, I knew that if to be honest with you, if the software, let me get my Dumbo ears on. I knew if the software didn't pick that up, then the software was probably worthless, because it's such an important concept, it's an important market action that it had to pick it up. And that's why I had Gavin speak on that. But you see the stopping action, because the market tried to go down and it went up. You can't see it real clearly here, but this particular bar on the left side of the bar is the opening range to the left of each bar that I have. So you open here and you close there. So as he described it also in a shakeout, boom, boom, that quick little, it was higher and lower. The important thing is you got heavy volume. Remember cause and effect? Increased volume, the range. There's a story there. Anybody not understand this? It's important. Tommy said we'll take the trade, and I would have taken it as well. The proper Wyckoff buy is where? A jump over the creek and a retest. So we know how this bottom was made, and we know how 9/11 bottomed the market. You can say, well, Gary, it didn't bottom for another 9 months. Patience. It's a process. It's a process. This is from that area. This is a continuation of the last chart. If you go back here, you see it's at April of 2003. Find April 2003 is right here. Jump over the creek. You see it? What's your safest Wyckoff trade? A retest of creek. Look at here. Look at those bars. I don't care about the bar by bar. We went over bar by bars a million times today. I'm telling you the whole story. But with Dr. Gary and Dave and everyone else, if you expand this out, you'll see it. This market rallied on very light volume all the way up. Why is light volume not bearish here? Anybody guess? When you, and this may be a little bit different than VSA, but I'm not sure. Okay? This particular, but I'm probably not. I'm going to test it. Once you are in an uptrend, What turns it down? Supply. A market, this is where people don't understand volume. This is why you're very lucky to be here. When a market is in an uptrend, and we know it's an uptrend, why? Because selling climax, and we already had our demand rally above the jump over the creek. This area here, all the way up, is not a very high volume, and it's a grind, right? You don't see ups, and you don't see it. When a market is in an uptrend, you do not need to see increasing volume. People say, oh, it's not going up in higher volume, it's bearish. I know working with VSA, looking at their stuff, they know when they get too high a volume, that's ending action. So you don't want to see that. Right. So this is a chart that a market can grind higher on light volume until you get supply. Oh, can't go. No, it's not true. People don't understand volume. Do you understand that? Where do we stop? We stopped at a double top, right? Everything else. Okay? Remember we talked about those, we asked a question about the bars, one being higher, one being lower, and I said the bulls and bears were fighting it out. You see that here. Okay? Then you had a little breaking of the ice, i.e. the S&Ps. This last week rally, what's that called? Last point of supply. This is where you find your trades again. 5-minute chart, 2-minute chart, 10-minute chart, weekly chart, yearly chart. If I didn't tell you this was a monthly chart and this was a minute chart, it's the same thing. Wyckoff was a trend follower, so he didn't tend to trade 1 minute, 5-minute noise. They did campaigns, they did everything else, but it still works. Now, let me explain another thing also about this chart. A buying climax on the highest volume, right, with the highest range, this chart lies to you. This chart has its highest rally, highest volume on preliminary support, right here. This particular chart, what is the action called down here? It's a retest on light volume. What does a retest on light volume tell you after climactic action? Lack of sellers. Look at the close. This is a spring. You see it here? I didn't draw it because I want you to keep the chart clean. This is a spring. You see that? That's a spring. Obvious is day long. You say, well, Gary, I don't want to trade a spring in a downtrend. They failed. That's what you told me yesterday. You're right. You missed it. Not a big deal. In hindsight, that's what that was. Okay. Now you remember David Weiss tells you, if you're waiting for a secondary test, the train left. Train left. It happens. Next chart. This is current. This is the monthly S&P. Remember we talked about we couldn't find a retest of that 2000, the lows that the daily made? You see it here. You see it as a spring. You must take the charts starting from the highest time frame to the lowest time frame. If you start out the monthly chart, you don't see it on the daily chart as a spring. Look at this spring you made. Or preliminary support, selling climax. Don't look at things as classical Wyckoff. If they happen, another biscuit for you. Understand the concept of bar reading. Nothing is perfect. If it's perfect, hey, wonderful. Nothing is perfect. Look for the action. Look for the signals. Look for signs. Read through the signs. Understand price action. This is why Wyckoff, when I tried to do the software back in the 80s, we had a problem with it at the time because of different variations of volume. Couldn't do it. Well, at least the guy couldn't do it, okay. It's done, obviously, but okay. I talked about reverse trend lines and trend lines. The low of this chart must be marked as 0.1, The first major reaction area, which we're doing now, is point 2. You take that and you make a parallel channel here. You see this? This was the last reaction high before a new low. It's a perfect channel. A trend line by itself means very little to Wyckoff. You see this line right here? If I slope that line a little bit more and then make it a little bit tighter, I'm off. So people say, oh, it broke my trend line. Oh, it didn't break mine. It's inaccurate. If you draw, I don't know if you can do it on your charts, I don't know, probably each single whatever it has. If you can draw these parallel channels, it will give you the perfect channel line to follow. Okay. This is it's fantastic. I mean, it's fantastic. If you could draw it, it's perfect. This is I use CQG, okay? But if they do, it's fantastic, okay? Notice how the market respected the overbought line. Remember I told you there's 2 ways the market's overbought, by point figure chart and by reverse trend lines? Look at this.
There's a question as well, came in from Stephen, I think I missed it, but he was just asking a question. On a secondary test, I think it might have been on the previous chart, it should be with lower volume than climactic. Why it doesn't on that chart 5, I think he says. So this is for Stephen. He said the secondary test should be with lower volume than climactic. Okay, well it wasn't a secondary test. I call that stopping volume.
Okay.
Just so you can answer that. I think there's 2 bouts of stopping volume, or you could even call it a shakeout. But if that was on very low volume, just before that stopping volume, that would be a no supply test. And let Stephen know that.
Great question. It's understanding of volume, which very, very few people do, which is why this was wonderful. If this was a light volume rally, it would have probably said lack of supply, correct? Because the ease of movement would have been up, this bar right here. I personally, if this volume was light on the up, I would have said that's a lack of demand, personally. Because the market went up on light volume after a retest. I would think that had to be retested again. So I would have been scared about that. This was a situation where, see this bar right here? Especially for Steve, it's a low-end bar. The likelihood of this bar continuing lower is likely the next month. It did. When the market started to go lower, right here, buyers came in. That's why the increase in volume. This bar is very, 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 very bullish. Very bullish because it is a market that tried to go down and the market was bought. You obviously, what does the close tell you? Who won the battle? They tried to sell it down at high volume and the buyer said, I'll take what you want. Give it to me. That's what happened. But having said that, we don't know if it's a secondary test going to come. You did get one. Or a shakeout, whatever. I call it stopping reaction because this range here has more volume, less range than this bar. See this bar right here? This bar's got high volume, larger range. This bar's got high volume, smaller range. It's what I called yesterday stuffing. Selling it down, buy it. They kept the range small. So if it went up in lighter volume, I would expect it another retest. The fact that it went up we talked yesterday about cause versus effect. There is not enough cause here to sustain. There's not enough cause here to sustain a market up. We cannot go far. We need to go in a situation where we need to do more cause. So we had a retest down here. If you start to go from here, you've only had 4 bars of cause, right? Cause and effect. We needed another 6 bars. The count's much larger on a monthly chart. It's a monthly chart. We take it, we go back to here. This is probably, and I'm probably overstep my bounds, but this is probably what Gav would call, and please correct me if I'm wrong. Last month, April, and there's a red flag, and I told people in my class why, my client-wise, see this bar here? What is that bar? Is it a large bar or small bar? It's tiny. Look at the volume. It's a little bit less, but that's a very small range for that volume. If that volume was like this, For the month? Okay. But this is probably what you call a no demand rally. I call it a shortening of the thrust or a lack of upside progress. But I'm sure it's the same thing.
We would call that supply coming in bar, and it would be a sign of weakness 26.
Okay.
Supply coming in.
And remember, I think David told you about vertical supply bars. You know, when a market has a wide bar, that's vertical. This is what you call a vertical supply bar. See this right here? A vertical supply bar?
Gary, take 5 minutes.
Okay, and it goes across. Okay? And it goes across and stops. So that's that. Let me run these real quickly. Okay? And let me tell you real quick in 5 minutes. It's a Boeing chart they did as an example. What's the first thing you ask a question when you get a question? You say, what is trend? What's the trend of this chart? Up, right? Do you see a trading range in this chart? Yeah, you do. Remember the Yao Ming examples and everything? Look at the volume. They're all on up bars, right? All on up bars. Market is bullish. Market's in an uptrend. A trading range in an uptrend does what? It leads to higher prices. Okay? You see that here. You see the jump over the creek here. The jump over the creek now becomes support. And here's your trading range. Okay? Obvious could be. Next chart. What is that bar? Last bar. Increased volume. I'm going to be we don't have time. Increased volume, and this is called your jump over the creek. You see that bar? It's the right side of the trading range. Not here. You don't put your position on here and wait. Look at these closes here. They're near the highs. It's absorption. It's what David called a hinge. Jump over the creek. Increased volume, demand. Market went higher. Jump over the creek. What do we look for? Look for halfway back or retest the creek. We got that here. You get a high and a retest here. Okay? Next bar. Key bar. After the retest down here, we rallied. What's this? This is your Yao Ming, as they would call it. Okay? Market went higher. Closed low end. High volume. Buying climax. Game over. Game over. You could be short on that bar at the stop of the high. Game over. You see the supply? Here? Highest volume, wide range, low close. Game is over. Next bar. We retest creek. We retest creek because previous resistance supports, we go here. Okay? Volume is high. Look at the close. With high volume, the market cannot go higher. It retested and closed lower. So that high volume, what I call stuffing volume, it tried to react from support right here. It couldn't, right? It couldn't react from support. Couldn't do it. It closed lower in high volume. That's selling. Even though you went to support, not all support should be bought. Support's bought in uptrend, not downtrends. That supply told you a change of behavior. We can't do anything with it. We can sell the market when we have an opportunity to. That bar, this bar here, that closed lower with high volume, sellers won. Okay? There was one chart missing in this particular chart, is that this market, if you look right here, where my arrow is, this here, it's at 72 cents. You see it here? Everybody see it? That's where the market's at today. It's classical. Just selling, I mean, I'm sure they have a term for that as well, but it's a buying climax. It's clear as day. High volume, wide range, closing low. So, another thing I want to tell you, one more thing. We did that point figure chart yesterday, and it gave you count, and I told you that was May 2nd in which I did this. If, on my website, if you go there, we did a class last Wednesday, and it shows the continuation. We do point figure charts in class on Wednesday evening, and it shows you that point figure chart that I showed you yesterday, what we thought would happen to the downside, the point figure chart was fulfilled on that chart. It's at the archives. I have 10 years of archives It's all free. You can browse. You can do whatever you want to do. But I want to thank you for your time, and because your time is more important than my time, believe me. And I appreciate everyone being here, and I think the fact that you're here learning this stuff, which 99.9% people will never learn, will never do, and to be with great people that put on a product that are telling you the truth about how markets actually work is a breath of fresh air, because the price and volume is the truth, and it's the right thing to do. So I want to thank you. If there are any questions, I'll be happy to answer them.
Yeah, was a question. Can you just re-clarify the Wyckoff wave? Exactly how, because that was the title. What is the wave, and how do you identify the wave? Just go back to
The Wyckoff wave is basically, it's not this in a sense. The Wyckoff wave really in the stock market course is, they call it an optimistic, pessimistic wave. And if you go to stockmarketinstitute.com, it will tell you about it. It's basically a series of about 20 different stocks that the stock market institute took arbitrarily. And they made like a Dow Jones out of them. They told strengths and weaknesses of it. And they made a wave chart out of this particular thing. The wave chart that went over today was essentially showing you the accumulation, distribution, and showing you the wave of the market, of how a market bottoms and how a market tops. So the Wyckoff wave, as we describe it today in how we work at things, is a wave that goes from a buying climax to a selling climax to accumulation to jump over the creek and all that nature. We have the whole processes of what I showed you in those two charts. The first chart that showed you of accumulation, that rarely takes you to a buying climax. The second chart of the schematic takes you from a top to the downside. So the wave meaning from low to high, high to low. Wyckoff wave in the course itself, they do more of an optimistic, pessimistic of the stocks I told you, but nobody used it. As a matter of fact, I talked to David, and David tried to construct one at one time, and they do it there, you know, but it's a proprietary type of thing in which they use particular stocks to make a wave based upon strengths and weaknesses, based upon harmony of the market. So that's the technical what their wave is. I wanted to show you the wave of buying and selling waves, okay? So, quite frankly, with all the bar chart that you have and the story of bar charts being together, this all ties in Wyckoff-wise. So we said, as Gavin told you yesterday, that Wood told you the story from here and there, okay? One more thing I want to say before I go. The stock market rallied from 1981 to 2000, went basically straight up. My opinion is that, I shouldn't necessarily give it, but is that you probably will stay in some type of trade range for the next 8 to 10 years. You just don't make highs and lows in stocks. You have to go through a period of accumulation or distribution, which I think that you're going through right now. So I wouldn't expect the market to get necessarily under 6,500 and above 15,000, the Dow, for another 8 to 10 years. You can say, well, Gary, that's 10,000. Boy, you're a genius. I don't know. You just went through one of the biggest rallies you've had, you know, in the 80s and 90s. So, but I think the market stays in some type of trading range now. So, you know, that's just my opinion-wise. So, you know, it's again, I want to thank you for being here. I think it was a wonderful weekend, and believe I've learned probably more than you did in a sense, because when you hear things get re-enhanced, and that's how you learn, by over and doing things repetitively. The more repetitive you are in doing your behavior, the more likely you're going to have a success. I'm not a psychiatrist or psychologist, but you know what? If you keep doing things repetitively and doing the right things, then I think you're going to have a better chance of success. Trading is the hardest thing you ever do in your life, in my opinion. But when you can read bar charts and read charts like this, I think that price and volume are the key to what you do. Again, I want to thank you for your time. I do appreciate you being here.
Brilliant. Thanks, Gary. Good job.